Price is noisy. Headlines are noisy. Charts move every second. But underneath all of that noise, there's a single quiet question the market is always asking. How much am I willing to pay for $1 of real earnings? That question is the heartbeat of investing, and it's exactly what today's conversation is about. As the title slide sets the tone, this isn't just a lesson on a formula. It's about learning to think like a rational owner, not a speculator. Because once you truly understand this one idea, you stop chasing hype and you start making decisions with clarity. Here's what we're uncovering together today. The PE ratio is not a magic number. It's a lens, a way to see expectations, fear, optimism, and discipline, all compressed into a single figure. And when you use it correctly, it changes how you look at businesses forever. Now, before we go any further, if you enjoy deep, practical breakdowns like this, content that helps you think sharper about money, business, and growth, make sure you subscribe, hit the thumbs up, and check the PDF linked below the video. It's designed to give you actionable notes you can use immediately. As the agenda slide comes into focus, notice how everything we'll discuss connects back to one core insight. Price only makes sense when you understand earnings. Without that, investing becomes guesswork. Let's build from the ground up. When we shift to the introduction slide, the PE ratio reveals its true purpose. It connects what the market is charging you today with what the business actually earns. If a company earns $1 per share and trades at $10, you're paying $10 for every dollar of profit. That's it. Simple, but powerful. Think of it like buying a rental property. You wouldn't just ask for the price, you'd ask, how much rent does this generate every year? Stocks are no different. The PE ratio is rent versus price, except the rent is earnings. This brings us to the fundamentals. Slide 4 highlights the basic formula, price divided by earnings per share. But the deeper lesson is what that number represents. A higher PE means the market expects growth. A lower PE often signals skepticism, fear, or neglect. Historically, companies trading at lower PE ratios, when those earnings are real and sustainable, have quietly outperformed over time. Not because they were exciting, but because expectations were already low. That's where disciplined investors live. Warren Buffett understood this early. He wasn't hunting cheap stocks. He was hunting reasonable prices for great businesses. Same idea, different words. Building on that idea, let's look at the different flavors of PE on the next slide. Trailing PE is grounded in reality. It uses the last 12 months of earnings, what the company already achieved. Forward PE, on the other hand, is a promise. It's based on forecasts, projections, and assumptions about the future. Neither is perfect. Trailing PE is backward-looking. Forward PE can be wildly optimistic, but together they tell a story. One shows you where the business has been. The other shows you where the market thinks it's going. Take a company like Amazon. Its trailing PE might look expensive at first glance, but forward PE often paints a different picture once expected growth kicks in. The lesson here isn't to pick one, it's to compare both and ask a better question. Are expectations reasonable? That question becomes critical as we move into interpreting PE values. On the next slide, notice how high PE ratios, say above 25 or 30, usually mean the market is betting on strong future growth. Sometimes that bet pays off, sometimes it doesn't. A low PE below 15 might signal undervaluation, or it might be a warning sign. Context is everything. Tesla's extremely high PE reflects belief in innovation and future dominance, not current earnings power. Alphabet's more moderate PE reflects strong, consistent cash flows. Same ratio. Very different stories. This is where many beginners fail. They see a number and stop thinking. Professionals see a number and start asking questions. What industry is this? Is the business cyclical? Are earnings stable? Is growth real or speculative? And that naturally leads us to the limitations of the PE ratio. As the next slide appears, it's important to slow down here. PE ignores debt, it ignores cash flow quality, it ignores one-time gains and losses. A company can look cheap simply because earnings are temporarily inflated. Cyclical businesses, like commodities or shipping, often show low PE ratios right before profits collapse. That's not value, that's a trap. This is why smart investors never use PE alone. They pair it with return on equity, balance sheet strength, and enterprise value metrics. They normalize earnings, they look beyond the surface. The PE ratio is a starting point, not a verdict. Now let's talk about integration, because knowledge without application is just entertainment. On the next slide, the real power of PE comes into focus. It becomes useful when you align it with your goals. Long-term investing rewards patience, not precision. Screening for companies trading below industry averages with solid fundamentals gives you a margin of safety. Peter Lynch famously used PE ratios to find companies the market ignored. Not because they were boring, but because they were misunderstood. That's where opportunity lives. You don't need to predict the future. You need to avoid overpaying for it. That idea carries us into the actionable takeaways. As the slide lists them out, notice how practical they are. Calculate PE regularly. Compare within industries. Track changes over time. Blend trailing and forward views. And always ask whether earnings quality supports the price. This isn't about finding the perfect stock. It's about building a repeatable decision process, one that protects you from emotion. And now, let's slow things down. The reflection slide isn't here to test you. It's here to sharpen you. How does PE shape your idea of fair value? Where do high or low ratios challenge your comfort zone? Are you drawn to excitement or to discipline? Because the market doesn't reward intelligence. It rewards behavior. This brings us to the conclusion. The final idea is simple, but it's worth repeating. The PE ratio is a compass, not a crystal ball. It won't tell you what will happen next, but it will tell you whether you're paying a sensible price for what exists today. When you internalize that, investing stops feeling like gambling. It starts feeling like ownership. As the final quote slide reminds us, price is what you pay. Value is what you get. Most people confuse the two. You don't have to. So here's your next step. Pick one company you already follow. Calculate its PE. Compare it to competitors. Ask what expectations are baked into the price. Do this consistently, and your thinking will change even before your portfolio does. If this video helped you see investing differently, subscribe to the channel, hit the notification bell, and download the full PDF linked in the description. It's designed to help you apply these ideas step by step, because the market will always be noisy. But clear thinking, that's a competitive advantage you can build today.